for another episode, another week. Today I want to talk to you guys about the power of compound interest, but before we get into the live Q&A, I'm just going to throw this out there. I've got more deals than I have capital to fund right now, especially in the US, in Florida. And I'm like just throwing this idea out there, but if you literally took like $500,000 and invested it and it paid 10% annual return, but compounded monthly and paid monthly, like passive income every month, and you invested that for like 35, 40 years, you're looking like $27 million, 500K to 27 million. I'm like, geez, that's impactful and powerful. I think that's where most people slip up is they don't think about the long-term, you know, power of compounding. A lot of people will take breaks, they'll have lost years, up years, and so they don't get that insane compounded annual growth rate. Sorry with my hair, guys. I didn't brush it before, so that's like, probably should wash it too. What else is going on in the world? So yeah, if you guys have been following the stock market, another down week. I've been playing a short position with some upside. So I have long positions that are theta decaying, and I have short positions which are theta decaying, and I'm winning pretty hard with both of them. So that's been a good week in the stocks. In real estate, again, just so many exciting deals. I can't share them yet, but there's too many coming across my desk to even have the money to fund. So I'm throwing out this idea. I'm going to be super picky. Like probably most people will reach out and be like, hey, I have 200 grand. And I'll be like, sorry, I can't work with you. But there might be someone out there who wants to fund one of these things. And I'm finding some really interesting deals. On the equity side, you take risk with equity, right? When you're not in first secured position as a debt holder and you're instead investing for equity, there's a chance of risk, right? So the the returns obviously on the equity side are much higher. Like over a 5 or 10 year period, you'll get probably double or triple the return. But again, there's risk with equity. So it's something that I'm focused on and acutely aware of. If you guys have any questions, by the way, throw them down below. Tonight's stream, I'm going to keep it to like probably 30 minutes or so, just because I've got, I'm not feeling the greatest tonight, and the kids are all, not feeling 100%. We're going to try to get a little bit of an early night tonight. So if you have any burning questions, throw them in the bottom now. As Dale says, good evening. Good evening. Mehmet says, greetings from Istanbul. Cool. Welcome to the stream. Dominic says, hey dude, how's it going? Other questions. How does it feel to be financially independent and not rely on a job? Also, how does it fall to live off of your asset base? Okay, I can talk about that stuff too. Yeah, I think that Dominic, the change is emotional as well as, there's some safety in it. I don't know how to describe it, but like I wake up most days and I feel safe in a way that I didn't feel before. Like when you go into a job, you can be fired tomorrow. But when you have a stable asset base that's diversified into many sectors where you're in real estate, you're in stocks, you might be doing some lending stuff, you got some business ownerships. But in the stock world, hopefully you're owning a small piece of thousands of businesses. So if one business goes bankrupt, you don't care. If a whole sector explodes, like tech explodes like it has, you don't care because you've got your oil and gas and you've got your other commodities and you've got your balanced portfolio, right? To me, that's the play, I think, is to build a diversified portfolio, and then you can never lose, right? Oh, sorry, I knocked over the stand here. I saw it falling, tried to save it, and was not able to save it. But whatever. So, sorry, the question was, how does it feel? It feels good. It feels great. I don't think there's any better feeling than the feeling of financial independence. I think that, whenever you're in a crappy job or you're in a crappy situation, for me, it's like I know I can just walk away and it's no big deal. I never have to stay in something I don't want to. The weird thing is, like, I still do a lot of things I don't want to do, and that's just part of life, I guess. Like being a dad, there's a lot of things that as a parent I have to do, like chores that aren't great. I end up doing a lot of construction stuff in my business that I don't want to be doing, but I do it anyway, mostly because I'm extremely frugal and cheap. But I'm trying to get away from that. I'm trying to focus more on outsourcing and doing the things that I love to do in life. And I think a big piece of that is just understanding that, my time has great value. And I only have so much time left in the world. Like I just turned 30. So, how many more years do I have left of quality? And I have to try to prioritize those. Thankfully, I spent my teenage years and my 20s grinding and building a great net worth, so I can just chill. I have more than the passive income that I could even spend. So it's a good feeling for sure. I wish it for everyone. That's why I started this channel 5 or 6 years ago, whenever I started it, is because I wanted to have that, to teach others to have that. And as a society, we would do so much better if everyone could just increase their savings rate a bit, because capital grow, especially in this economy we're in today. A dollar of capital is more important than a dollar of labor. And over time, labor is going to become less and less valuable. So the only thing you have to offer society is your labor. Unfortunately, you're going to become less and less valuable to society, to the point where like literally you're meaningless. Like if you have no high income skills and your input is like crappy labor and you have no capital to contribute, meaning like technological advancement, because capital produces machinery, and machinery can produce more labor than you can soon, especially with the invention and assistance of AI, which is a whole other topic and is a scary thing, at the end of the day as well, right? There's that fear of AI kind of, doing what it does in some of the blockbuster movies we've seen where AI sort of takes over the world and decides to, well, comes to that same realization that humans are basically flesh bags that don't contribute anything. And once we don't contribute anything and AI is more creative, smarter, et cetera, so forth, that's sort of a dystopian reality. And hopefully we don't get there. Hopefully there's good governance in place and we never let AI get to that point. But yeah, so how does it feel to live off an asset base? Well, it feels fine. The second part of your question, I guess, to me, it's more stable. It's more safe. It's more comfortable than a salary that can be gone tomorrow. So that's a big piece of it. Part of why I titled today's video "The Compounding Rule" is like a lot of people don't compound their income. They don't reinvest a lot of what they're making. They go and they buy a car, they spend it, and so I think that's a big disconnect in society today. Like the average person is saving like 3%, and that's like, that's good. They're in the top half, right? 3% is not going to move the needle forward. You need to be saving a lot more of what you're making. And if you can't do that, well, find ways to make more money, right? Strategies to earn income, increase your day job, whatever. Then as you can start saving that, of course, then you can invest it, and that will grow your top line income too, because those assets then produce positive yield, positive cash flow every year and every month. So that's what I want for everyone. That's what I hope everyone can gain out of that. Sipo says hello from Hamilton. Hello, how are you? Sipo says, finally I get the chance to participate in a live by accident, because if I turn on notifications, I still don't get any. Yeah, YouTube tends to not send any notifications out for my streams lately. I don't know what's up with that, but tonight's stream probably, I see the viewership's not doing very well, probably because I labeled it some generic, what did I say, like 10%, whatever. You'll get more activity when I put like real estate in the title, or I put, some sort of catchphrasey thing. And I also uploaded some weird thumbnail. I couldn't figure out how to get it off. I clicked the wrong button and it was stuck in there and it wouldn't let me upload a picture. So that's probably not helping. But yeah, participating live. Well, I'm glad you're joining the stream anyway, so welcome. Sipo says, I had a question about real estate. There's property that is pretty much refinanced to the max. Should it be put on the market to avoid rate hike, or attempt to monetize it somehow to keep it longer? Sipo, I guess the short answer is it depends. The longer answer is we need more nuanced information for me to give you a good, accurate read. But probably, if you're not cash flow positive, you need to make a plan for how you're going to become cash flow positive. So is there a way you can change the property and pivot in some way to get there? The challenge, I guess, is like you said, there's not much equity in the property, right? Because if you've bought a property in 2022, then currently there's no equity. If you bought a property for $1 million, it's worth 800 now. You put 200 down. If your 200 is gone, there's nothing. So that's common, especially in Ontario, where prices have fallen quite a bit. And so that's why I say it's important to have property you can cash flow, because in that situation, you just be able to hold it. And in 5 years from now, the property will be worth $1 million again, or $1 million too. And so you only really lose if you sell at the bottom. Same in the stock market. Like if you are holding a quality basket of like S&P 500 quality companies and you're diversified and the portfolio drops 20%, don't sell. You never sell when it's down. You wait, and over the long term, you always win, assuming you're diversified. If you're holding like 3 companies, then yeah, they could all go to zero and you can be screwed. But if you hold the entire market, you can never go to zero. It just doesn't happen. The market always goes up long term over time. You always win. That's why it's important to diversify in what you're doing. But I guess the short answer is it depends. Can you afford to feed this thing? And hopefully you can. Hopefully you run your numbers in a way that you can do that. Can you increase the cash flow in some ways, or you can add a bedroom, Airbnb it maybe for a bit to increase the cash flow, invest in some furniture that would then get you a much higher yield. Like if market rent's $2,000 on Airbnb, you could do $3,000 a month. You might have to invest $10,000 in furniture, but if you get an extra $1,000 a month, in 10 months that's paid off, and in the long term you get a much better ROI on furnishing the space. So I'm big into furnished rentals. Not only that, but your property looks good. It's staged and ready if you want to get it refinanced and appraised. If you ever want to sell it, you're ready to go. You get a higher value versus a vacant property. You tend to sell for 5 to 10% more if it's staged. So big fan of that method of juicing cash flow up. But there's always ways to twist your tongue to get the deal more palatable. Will, good evening. How you doing? Daryl says, should we buy properties in Naples, Fort Lauderdale, Florida using an LLC or a Canadian Corp? Daryl, I wish I had a good answer on this. I've spoken to several professionals, and the answer is it is situationally dependent. But generally, the general consensus from every professional that I've talked to is that as a Canadian investing in the US, you want to avoid double taxation. And so I think the cleanest way to do that from a liability perspective and the cheapest way is to set up some sort of Wyoming LP GP structure. And the GP is a C Corp, also in Wyoming. Wyoming has lower filing fees, corporate veil, piercing rules, low court filing costs, a number of reasons why Wyoming makes a lot of sense. But further pursuant to that, I think that the LP GP structure is important because one, liability, and that, by the way, owns a LLC, let's say in Florida, if you're buying in Florida. So the LLC owned by the LP GP structure, and then maybe your Canadian Corp could own that. You could personally own that structure. A lot of people have the corporation in Canada as that extra layer of tax deferral. But the idea is the LP GP structure, specifically the LP side, 99.9% of it would be LP, 0.1% would be like GP. That C Corp, it is taxed, but you bleed so little of it to it. You put like 0.1% of the profit to it that it runs at break even with the filing fees of keeping it alive. You have to deduct those, so there's no tax. The rest of it is a flow through. So LLC flows through the LP, which flows back. And you do pay tax in the US, so you're gonna pay your 21% federal tax, your 5% state tax. So this whole like tax-free thing in Florida, no, like 26% tax. But then you're gonna get credit for that in Canada. So it's gonna work out about to not much tax, probably a little bit more in that regard. But you avoid double taxation, which is super important, because if you don't structure it right and you pay tax in the US and you don't get a credit for that, like in certain entities do not flow, like a C Corp does not flow through to Canada, and you won't get the tax credits for those. So be careful. I've heard of some like wonky structures that don't save you from double taxation. So double taxation is super, super important. I couldn't sit on this chair because this little stool that I had, it made it so that you couldn't see me. I was sitting up high and you couldn't see my face. So I'm literally sitting on the floor right now, but that's how it is. Okay. C-Post says hello from Hamilton. Oh, I'm lost my spot. Okay, found it. So to answer your question, Daryl, the last part of it was Naples. So it doesn't matter where you buy properties. It would make no difference from the LLC structure. You could, in theory, buy a property in your personal name and have no double taxation because there's a tax treaty between Canada and the United States. And any tax you have to pay in Canada or in the US, you would then pay in Canada. The challenge I find with Canadians investing in real estate in Florida is that they don't think about the liability. So I think that's where the LP GP structure is super important. One, you get to defer tax potentially and roll it into your Canadian Corp at the end of the three-tiered structure, so to speak. But further, I think it's just liability, right? Like everyone's so litigious in the US. It's not like in Canada. Everyone sues each other for everything, and it's scary. So you want to protect yourself against that. Your first line of defense is obviously your insurance policy on the property, but after that, you're going to have the LLC giving you some level of protection, and then the LPGP structure, and then it's going to flow through to some sort of structure in Canada. For me, I'm probably looking at moving to the Bahamas very soon. I'm going to live a life between, I'll be living in the Bahamas, but I'll be working in the United States, probably get an E2 visa to work in Florida, 60 miles from the Bahamas, right? Super close. I could fly back and forth or boat or whatever. There's a cruise ship that has overnight cruise that goes back and forth. It's super awesome. I'd probably do that a lot. But yeah, just having like a flight, it's a 60-mile commute. So you could do it in a boat in about an hour and a half. You have your own boat. And if you're flying, you could do it in about 20 minutes. So it's a 20-minute, it's like driving across like Toronto to get dinner with friends. That's going to the Bahamas to Florida. So you could do it every day. You could literally commute every day if you wanted to. It's feasible. 60 miles is not that far. But anyway, so my plan is to do that because the Bahamas have no tax filing at all. Meaning you pay no capital gains tax, no income tax, nothing. You buy shares in Tesla, they 10x, you sell them, nothing. You buy Bitcoin at $1, it becomes $1 billion, no tax, no filing at all, nothing. Zero reporting at all. You don't even file a tax return. There is no tax time in the Bahamas. So that's attractive, especially for Canadians because we don't get taxed on worldwide income. We can become tax residents there. You need 90 days a year in the Bahamas. Super great. structure. So for me, I think that's probably the way I'm going to go. And I'm going to have like a Bahamas Corp that would probably own my Florida LLCs. And so the nice thing about that though, you're thinking, oh, well, like how do you avoid tax when you own real estate in the US or Canada? You can't. Like there's going to be income tax on income earned from US assets that are generating income in the US by having a business basically running in the US. You can't avoid tax. But depreciation schedules in the United States, super cool. So I don't know if anyone knows this, but anyone can 1031 exchange. Canadians can 1031 exchange, resident aliens can 1031 exchange, anyone can do a 1031 exchange. The problem is if you stay a Canadian citizen, then they'll let you 1031 exchange. You won't owe any capital gains tax to the government if you sell your asset and buy something bigger. You can just defer tax. But the Canadian government's going to say, hey, you're a Canadian citizen. We want to tax you what you're doing in Canada or what you're doing in the United States. Give us a piece. We're going to charge you 26% capital gains tax. And they'll just ravage you. And so that's where you get destroyed with you don't get the 1031 exchange if you're a Canadian. But if you were to become not a Canadian, where you could, in theory, be a tax resident elsewhere, in the Bahamas, let's say, if you're a Bahamas resident, you're investing into Florida, you get the 1031 exchange. You don't have to be a U.S. citizen at all to have that. A lot of people think you need to be a U.S. resident to get the 1031 exchange. You don't. Also, the depreciation schedules are super dirty in the U.S., so no one actually pays any tax at all. You have a 25-unit building doing $1 million gross a year on Airbnb. You're probably netting 10, 20, 30,000 a month in cash flow. You can find depreciation expenses that get that netted to zero, and then you never pay any capital gains tax on all that depreciation that you're basically lowering the cost base on your asset over time. So when you do eventually sell it, there's a huge capital gain. But there isn't, because you just 1031 exchange until you die. And then you step up cost base and your heir inherits that and avoids paying tax as well. So the US tax system can be very lucrative. You can effectively go decades paying no tax using real estate. So it's a non-issue, I think, if you structure properly. But Canada really gets in the way because we have no 1031 exchange. So they nail you if you try to size up the building bigger by selling it and buying something else. If you flip, just in general, Canada's tax laws are horrible and driving me away. But I love Canada. It's a beautiful country. I plan to spend my summers there visiting family. I still want to operate a business there to some extent, but less and less so. More and more I want to invest in the US. There's just, as an example, let's say in Ontario, I'm looking at hotels. There's like 3 for sale in all of Ontario. I go on the Florida different sites and I find 1,000 hotels for sale. Like they're everywhere. There's just 10x of everything. It's just bigger, better. The lender market, everything's just more fruitful as a capitalist. You can make so much more money because there's just so much more opportunity. And so I love that about the United States. I love that about Florida, is that there's just, again, so much opportunity. Whereas Canada just doesn't have that. Like, people hold on to properties and a lot of stuff doesn't turn over. A lot of good stuff anyway. You'll see a lot of houses and stuff, but there's not a lot of cash flow in buying a house in like Toronto or even London these days. Like a single family house doesn't cash flow in most markets in Ontario. So it's not only that, but like the landlord tenant board in Ontario is pretty shit. You have no control of your property. Your tenant owns your property, not you. If you want to evict them, it's about 1.5 years just to get an eviction. And that's if they stop paying. If they make partial payments, it could go for longer. If they destroy your property, you have no recourse unless they're rich. So look for rich tenants. That's the key. Make sure they have something to lose. Good credit score and a lot to lose. Most of the tenants don't, though, unfortunately. They're pretty much bums. The bottom half of tenants, and like, it's just the reality, right? Like, tenants tend to be the bottom half of Canadians anyway. I mean, there are exceptions to the rule. People who are doctors, whatever, moving for their job, and so they need to rent. But primarily, people who rent tend to be making less income and tend to be struggling with poverty more. So you just get a lot more of that in that, entry-level house that cash flows in Canada. All right, next question. Melina says, hi from Toronto. Hey, Melina. Or Melina, maybe I mispronounced that. Baker says, hey, Mike, how could one set up an online coaching call with you? In this current market, would you buy a property in cash outright, or would you get a mortgage? I would never buy a property outright in cash unless it's to temporarily increase the value and then go back and refinance it. So the only time it makes sense, I think, to buy in cash is temporarily, like for a 6-month period while you're establishing the asset, because maybe you buy a property that's distressed that you need to close on cash because financing is difficult on it, or it's as is, and so there's some value play. If you put a mortgage on it at the outset, then there's a lot of fees to disperse that mortgage and put another bigger mortgage on it or refinance it out. So that's why we buy in cash, but we never stay in cash. Like owning real estate for the long term in cash is probably the stupidest thing you can do, in my opinion. Like you're not going to get 10% compounded annual return owning real estate in cash unless you're buying like in Florida, you could do it probably with C-class properties, but you're not going to do that in Ontario and Canada. In most major metropolitan markets, any city that's really desirable to live in with over 500,000 people is going to have the cap rates so low that there's no cash flow owning in cash. So the reason why I say that is like you never want to, a lot of people have this misconception you want to pay down the property. You don't want to pay down the property. As it starts getting paid down, you go back to the bank, you refinance. You pull the money out, you buy two more. Because like for all the people who are like, oh, Mike, Dave Ramsey and all those guys who say pay off the debt, don't use debt stupidly. Like if you're stupid, don't use debt. So for the majority of people who can't control their impulses and just rack if you give them a credit card, they'll rack the whole 10,000 limit up. I mean, okay, those people maybe shouldn't have any debt at all, and it's easier to say that to them. But in general, I use this example, and it's the easiest example to explain it. Every time I tell it to someone, they're like, light bulb clicks off. Would you rather have one property paid off in cash or 5 properties at 20% down? If you map it out, let's say this properties are 200,000 a piece, 5 of them is $1 million in real estate. If it appreciates over 3% a year for 5 years, you're looking at like compounded around 18, 20% appreciation, right? With the compounding effect. That 20% appreciation, let's say on this $1 million portfolio, is $200,000 in gains. You put $200,000 down, you got another 20% appreciation, which means on your down payment, the money you put in, your 200 grand, is now worth, you have equity of 1.2 million in the property. The mortgages are say 800, assuming that they never got paid down at all. Your 200,000 has become 400. You've doubled your money. You have a 100% return with a 3% inflation. The same is true, or just not true, for the house you own outright versus the 5. So the house you own outright, obviously, you've got a little bit more cash flow because you're not paying interest on that. But you're just getting you're just effectively saving the interest rate, which is usually a single digit 4, 5, 6% returns. That's your yield that you're saving. But if you run the math on this over 5 years, let's say, same example, this $200,000 property, it's appreciated 20%, you made 40 grand. So your 200 grand has made you 40 grand. Do the math on that, you've made 20%. So you could have made 100% return and plus cash flow, by the way. You're going to have mortgage to service on all 5 of these, but if you're buying smart, you still have positive cash flow. And this one, you might have $1,500 a month in positive cash flow. This one, you might have $500 a month in positive cash flow. So instead of $1,500, you have $500. You're like, oh, $500 is a lot less than $1,500, but the same amount of money, that $200,000, bought you 5 houses with mortgages. So now you have $500, $500, $500, $500, $500, $2,500 a month coming in. And the appreciation is 5x. So over the long period of time, owning in cash keeps you poor. There's no one that made insane amounts of wealth in real estate owning in cash and trying to pay off properties. Nuh-uh. You lever up the properties, use them as equity and collateral to grow and to build. And a big portfolio is safer too. One property, you lose it, something bad happens, a tenant comes through and destroys the property, has some vacancy, you're screwed. Your $1,500 a month becomes zero. This happens, it can happen. One of your properties that happens, you lose the $500 a month, you're still making $2,000 a month. In fact, these 4 make enough to cover the 5th one that's been destroyed by the tenant. So you have safety in numbers as opposed to having one property. Your vacancy rate is much lower across larger portfolios. There's safety and diversification in real estate. So you definitely do not want to pay down your property. You want to remortgage it every few years, take that capital and buy more quality assets. And if the assets don't cash flow when you lever them up, because people come to me and say, hey, Mike, in Toronto, in New York, in LA, in whatever city, Vancouver, this doesn't work, Mike. We don't get cash flow. And I'm like, don't buy in those markets. They're like, well, the only way it works is if I buy it in cash. I'm like, then don't buy that house. Why are you buying assets that aren't cash flow positive with debt on them? Period. Period. Just full stop. Go to another market. It's very easy to invest virtually. Like nowadays, even when I'm in the city, I don't go to my own properties. I have a property manager that I pay. You can pay $25 an hour to a property manager. You can pay a good maintenance guy $25 an hour as well to maintain your property as well. You're just coordinating on your phone. Now more than ever, it's become a very virtual, easy business where you check on the property once a month. No big deal. It's very, very easy to maintain a property virtually nowadays with the way technology is moving. It's getting easier and easier, right? No one collects rent in cash anymore. Like that's dead. So yeah. Okay, so Baker, last part of your question. How do you set up online coaching call? You can reach out to me at rosehartcapital@gmail.com. or rosehartcoaching@gmail.com, and I will respond back. And I do coaching calls occasionally. I try not to do them very often because I don't enjoy doing the calls all that much. But my two package, if you want to do two calls with me, I think it's $13.49 is the sale price. If you want to do one with me, it's supposed to be $7.99 is the sale price right now. I have charged up to $1,000, so it varies on my mood, but you can get a tremendous amount of value. Everyone I've done the coaching calls with has come back to me and be like, man, I reoptimized my portfolio, or I changed the outlook of my life in a big way. And they attributed a lot of the value to that. And the way I look at it is like this: like, you could have me as a JV partner. You could bring me on. I could help you through the renovations and all of that. I actually offer that as a thing as well. I sometimes will do, where I'll JV you for equity, or I'll coach for equity. But that'll cost you 50% of your profit. If you're gonna make 100 grand, that's 50 grand. You could instead just book like 6 calls with me. You could do like a call a month for the whole project. You could have me as basically a partner on that deal, helping you to optimize things and make sure you don't make those critical mistakes. And it's just like an accountability, reality check, and just hearing yourself say what you're doing and then thinking that through with another person is hugely valuable, especially someone who's been through those hurdles, right? And knows the things you need to avoid. So there's tremendous value in it. I don't want to have a full-time coaching business right now. I'm just not interested in that, but I'm working with and needing and kind of playing with the dough when it comes to making some sort of mentorship program where I took like 10 people on and taught them how to wholesale, taught them how to buy properties at a discount, and then made them a part of a business. Like, I had this sort of vision of this like Rosehart roundtable of people that are like a tribe of people who have a similar mindset that I do. And there's something to that. So I may build something like that out. I don't know. Still noodling with how I would do it, and from a time commitment, how I would manage it and how it would look, because I want to deliver quality more than anything else. So I'd probably partner with someone to help me on the operations side to deliver a quality experience. But a lot of it comes down to just, I've been through a lot of the things that people are going through, and I've failed through a lot of that, and I've learned a lot. And so I can share those nuggets of wisdom. And it might cost you $1,000, but you might save $5,000. And so that would be a great return on investment, right? Like, if you were otherwise not going to do a deal at all and sitting on cash, and that one call got you to go deploy that $500,000 and make you 20% in the year, I mean, that's a $100,000 return. So that's a lot more than what you paid to get that, right? So it can be extremely valuable to do coaching and mentorship, but it's for each person their own, right? Like, you can learn most of what I have to teach if you just watch 1,000 hours of all the top mentors in the space and went on Google and learned and digested. You could probably figure out everything you need to know, but what's 1,000 hours of your time worth when you can condense that down to a lesser amount of time? If your time is valuable, that can be a huge savings. So each person is different. Each person's got a different fit, but yeah, cool. Next question. Do you think there will ever be a recovery in interest rates? Yeah, I think that it's impossible for rates to stay high for long. Like, we're talking 5-10 years from now, yeah, rates will have stabilized during that point. And it'll probably look like this, right? So there'll be points where rates come down. Like, we just came out of a trough where rates were down in early January. People were expecting the market had priced in the bond market. Yields had fallen to the point where they were actually expecting the second half of this year for rates to drop. Rates are not dropping, by the way. Like, every company out there is laying people off. Inflation's still high. Every union is negotiating 20, 30% raises over a 3 to 5 year period for their staff. That makes inflation sticky. That makes it not transitory, which I knew was going, like, it was obvious when the Fed was coming on and be like, hey, it's going to be transitory. And the market's like, it's going to be transitory. I'm like, I'm opening short contracts in my brokerage account because I'm like, no, it ain't transitory. Rates are going up next week. Next week, the Fed's going to raise rates either 25 basis points or 50 basis points more in the US. So more pain is coming. But where will it end? When will they pivot? When they break the economy. There's the rock and the hard place, right? The hard place is if they let up on rates too soon and they bring rates back down, that would save all of us who are struggling with debt. People have mortgages, people who are, credit card debt. I don't have any of that, but there's a lot of people struggling with that stuff. And, I definitely feel the mortgage piece of it. And that part of my business will struggle. Cash flow is reduced as rates stay high, right, for longer. But the U.S. economy, like, they owe so much more than they produce of their GDP. And they have to service the debt. And the budget is now going to be like 30% of the government spending in the US and in Canada. When you look at the budgets, the majority is going to become interest servicing cost. They're going to have to either raise tax rates to pay for that, or they're going to have to lower rates because it's going to crush, like, even the government can't sustain its own debt. It's riddled up to its eyeballs in debt. So long term, we can't go through a phase like we did in the 80s. It just can't happen. It just won't happen. The market will break. Rates will come back down. I hope the Fed stays with conviction, because breaking the economy is a lot better than the alternative. The alternative is that inflation runs wild and isn't transitory. And we have high inflation for a long time. And that's really bad because all of our assets appreciate in value. But more importantly, they tax the shit out of that and we lose our buying power. So yes, assets will run wild, but the cost of, you can't do business when you can't predict the cost of something. Like a contract to build something, a 2-year project to build a big building. How are you going to do business when there's no stability in the price of the currency? If inflation's running wild, business can't be conducted properly and the market falls apart as well. It leads to basically people starving in the streets and death. Poverty is one of the leading killers, actually. So recessions actually kill more people than wars, random fact. So recessions do kill more people than wars through suicide, starvation, mental illness. All of that rises dramatically as you induce poverty on a society. So scary shit, but real talk, guys. I think rates will come down. I hope the Fed stays strong, and I prefer that they crush the job market and they crush things a little bit in the stock market and in the real estate world and all the business world, so that we don't have hyperinflation, because hyperinflation is worse. So hopefully they don't pivot early. I really do. Like, the Fed does sound like they've even shifted one of the members of the Feds. The reason I talk about the Fed and I'm a Canadian is because the US sets the global standard. So if the US raises rates and Canada doesn't, Canada said they're going to pause for a bit. But if the US starts going harder, and they are going to go harder, then Canada has to follow suit, or the Canadian dollar falls in value to the US dollar. So we have a currency destabilization. And because Canada exports a lot of natural resources, specifically and exports stuff to the United States, that crushes our economy. Our dollar can't fall like that. So we have to then raise rates too to keep up and ensure that our currency remains somewhat pegged. If you look at the last year, US to Canadian was $1.21. Now it's $1.36. So we've got a 15% drop in Canadian currency relative to the US dollar. That's normal in times of peril or war or recession. It's because everyone flees to safe, stable currencies they believe in the US dollar. And for now, that's the case. For the long term, I don't know. I think that China, India have the potential to overtake, as far as like being a superpower and a global currency. For now, the US is a bully. And they say that our dollar doesn't need to be backed by gold because it's backed by the strongest military power in the world. And currently the strongest GDP, but mostly the strongest military in the world. So that's what you can believe in when you buy US dollars, that it's backed by the fact that they'll go to war and fuck up anyone to protect their dollar. They will, like they're dirty. So that's something that's comforting about owning US dollars. I know Canada's a pussy, so like there's no safety in Canadian dollars. Trudeau's some of the worst leadership I've ever seen. He's the least qualified prime minister, just like factually, whether you like him or not. He's got a good looking face, and he's maybe a nice guy to have a beer with, but like just like factually, he's the only prime minister Canada has ever had in the last century and a half or whatever that hasn't had either both or one, a law degree, a practicing lawyer, and a master's in economics, or both. Every single prime minister we've ever had in the past was a lawyer with an MBA or some sort of economics degree and practiced law. I think every single prime minister before him, he's a drama teacher. So like Canadian leadership, horrible. Canada's a great place. We're one of the largest land masses with some of the most natural resources like water, quality, fertile soil, just a number of things Canada has going for it. It's a beautiful, amazing country, and people are so nice. I love Canadians. Wherever I go, I'm like, I love with being a fellow Canadian. I will always be a Canadian at heart. We are unfortunately led by some bad policies lately, and Canadians are so nice that we let anything fly. Like they locked down our whole country. They're like, hey, if you're not vaccinated, you can't go into Home Depot, can't go to the pharmacy to get medicine. They were talking about starting off grocery stores and having drop-off locations. Like you couldn't go anywhere, couldn't go to the movie theaters. It was like 1930s Germany and you were a Jew if you were unvaccinated. Like legitimately, that's how bad it got in Canada. And everyone's like, it's okay. Canadians are like, oh, it's okay. Like, sorry. Like we're just pushovers a little bit, right? Majority of Canadians. So that's I don't want to get political, but Canada's a beautiful country. Politically, it's a little bit messed up, some bad management, but people are so nice and so kind. And the topography of Canada is just a beautiful place. If it didn't have such a bad tax policy, I would probably stay in Canada. I'm being driven out because of it started with the pandemic response, which has mostly been muted now. Thankfully to the Freedom Convoy and people standing up and saying, hey, we're not going to take this shit. And I'm glad that there's some Canadians that are pretty badass and stood up and said, hey, like I had friends who were there, and I had friends on both sides of it. So like I'm I'm indifferent, right? Like I hear both sides of the story and I can respect where both sides are coming from. I'm kind of in the middle, like, you know, on one side, I kind of see the arguments on both pieces. So be a good human being, I guess, wear a mask. That kind of makes sense to me. Like if you're sick, put a mask on so you don't cough on someone and share your germs, right? I guess that the efficacy of masks for preventing COVID has not been all that great when they studied it. And I get that like the efficacy of the vaccines is questionable as well. But anyway, you know, I get that. Some people are doing it to protect elderly or people in their family. And so like, I respect that as a Canadian who has like a good heart. I'm like, you know what? I respect a person's right to, you know, feel safe. And, you know, I just think that they didn't handle things as well as they could have. There could have been, you know, isolation centers where they could have effectively treated anyone who had COVID, like hospitals that popped up just for COVID, kept our hospitals safe. As one example of many for the poor leadership we saw in the province and the country, but it was a, you know, curveball for the whole world. All right, next question. Do you think there will ever be a recovery in interest rates? The next one was, how can Canada ever recover? Well, Canada's still on its way down because real estate is lagged. Builders right now are suffering. Developers are suffering. They're finishing off the projects they're on. And what I'm hearing when I talk to people in the field who are employers of contractors and trades, when I talk to builders in Canada specifically, it's slowing down big time. It has slowed down and layoffs are starting. So there's a plethora of trades now where there wasn't before. And they can't, if they were getting $100 an hour, now they have to get 50. So wages are falling in the trades and there's a lot of available labor, which is great for building a business because you can pick out loyal people who are desperate right now and get them at a discount and get them working and build them as part of your team. And so in the next bull market, you've got loyal people who will bleed for you. And so I think that can be a really great thing. The opportunity here is huge. There are so many opportunities right now to take advantage of. I really just think that this is a time to hunker down your business and to develop it and to build a really robust real estate business into the next boom cycle. You can potentially make, you know, a 500% return between now and the next 7-8 years. So there's a huge amount of opportunity. As far as recovery goes, it will recover. Like Canada's an amazing country with a huge immigration list. Like there's people begging to move to Canada because again, we are so socialist. We have free healthcare, free dental is coming out now, free medication. Like, yes, you wait forever to get served, but it is free and included. And we have programs that give tons of money to people who come here. If you come to Canada and you're like a Syrian refugee, you bring 6 kids with you, the government of Canada will give you tax-free like 70 grand a year. You don't need to work. They go drive taxi on the side and pay no tax or work construction for cash and just collect 70 grand a year from the government. Like we have some really great social programs, especially if you have kids. $650 cash a month, tax-free per child. So that's insane, right? You get a stipend when you move here, you get some income. But if we could take on, like, Canada will be fine. My point is Canada will be fine because we're a huge country, has lots of room, lots of natural resources, and there's a long list of people wanting to come to Canada. So for that reason, I think that Canada will continue to survive on immigration. They're talking 500,000 people a year, and our population's 35 million? So they're literally trying to increase the population 3% a year through immigration. So we will double in size. It will happen. Canada is going to be a great place long term. They can't keep up on a supply demand curve. It's really hard to build anything right now in Canada. So we're going to have a supply demand shortage. So long term fundamentals for Canada are really strong. So if you're holding that property for the long term, you will be fine. Long term, you'll be really solid. Cashing out now might not be the best call because again, you're cashing out towards the bottom. But my point is, with all those people being laid off, that again, real estate is one of the largest drivers of GDP in Ontario. So think about that. GDP is going to fall if all these construction projects are frozen. There's no money because credit markets freeze up. When rates are this high, everyone just moves from investing in equity projects to doing debt projects. So then the money dries up because everyone just jumps to treasuries and can get yield of 5-6%. Why would they take a risk at 10% on someone's building? It just doesn't make sense. So that's where I think what we'll see, all those people being laid off, those trades are going to default on their mortgages. But that takes, in Canada, a year before you get to foreclose on their house. So we're talking about like the ramifications of these layoffs now. 6 months, they'll rack up debt on their credit cards, they'll survive, then eventually they'll get so far behind they can't keep up, then they'll foreclose, then it's a year from then before that property hits the market. So all that inventory that's going to bring prices down further, we shouldn't see that trickle, and it'll be over time, it'll be slowly, right? But we won't see that trickling bottom for probably another 2 years. So real estate, the big drop has happened. I think we're just kind of a trickle, like where maybe we're up for a little bit, but like kind of sideways downward pressure. And the very bottom should be December 2026 is my forecast. December, because seasonally prices drop 9% from the spring. So if you sell a property in April, May, if you look at the price chart in Ontario, if there's a number of reasons why this happens. One is like it's cold, but two is everyone just doesn't want to buy something till the spring because properties don't look nice. They don't list their property when it's snowing and gross and sleet and hail and all of that. So properties don't look nice. They don't sell for as much. But further, the depression of the cold actually gets people not to bid as high. They don't go outside as much. They don't see the listings. But moreover, more importantly, is that people will buy in the spring because they want to close in the summer and move in before the school year starts. Most people have kids. So that's a big driver. If you just look at seasonally over the last 30 years, Canada always has a peak, and Ontario specifically, every single year, December is the time to buy. Just even if the market was flat, there'd be a 9% drop between May and December. That's just a seasonality thing. So my guess is that'll be the bottom, is somewhere around December and it takes about 2-3 years for the effects of this to be felt. Unless, of course, the Fed pivots early and inflation runs and they lower rates, in which case things will just go crazy. We don't really want that because then inflation will go crazy. We don't want that yet. I hope that they can get inflation under control first before they do that. So we'll see. It's we're gonna find out how they land the plane. There's a bit of uncertainty, but I would bet over the long term, 100% in 5 to 10 years, that property worth way more money than what it is now. So if you can hold, and you're worried about like the fact that you're underwater right now, you have no equity in the property, and you can find a way to Airbnb it or cash flow it to continue to hold for a while, you will win long term. And maybe you got to put in $200 a month to subsidize the cash flow because rates are so crazy right now. Maybe you got to pay on your mortgage a little bit so the numbers can work. That sucks temporarily, I agree, it's not ideal. But over the long term, you'll win in a big way. So hold in there. Don't panic. Panicked investors that panic sell always get screwed. Every time I've panic sold, I regretted it. Like, I pretty much only regret when I sell a property, never when I hold it for the long term. Hold the property for the long term, buy quality assets. If you're gonna come to me and say, hey, Mike, I might sell this condo and buy this other property in the town that's a duplex and that or is in a different way, better cash flow at the same price point or better cap rate, I'll support that decision all day. Let's harvest those losses, write them off, create a nice leeway of tax savings, and then buy something else. So you're still in the market. So when it appreciates over the long term, you win, and you're in a cash flow positive. So I often get on calls and we rebalance. So we'll sell assets off, like real estate properties that don't make sense, but buy other ones that do make sense. So I guess I'm bullish on real estate, but the right real estate, because I would say probably 8 out of 10 properties aren't good. Like 8 out of 10 landlords are shit landlords. And so when you meet someone who's like, hey, I got 20 properties, and I look at their portfolio and it's shit, it's like 3 cap. And I'm like, man, like this is just a bad portfolio of real estate. But they're a landlord. They've been in the business a long time. Maybe they made a lot of money, but they're not optimized. And so what you want to be is optimized. 8 out of 10 landlords are not optimized. And it just is. Not everyone can be top 1%, right? There's going to be people who are just owning properties with no cash flow, own the property for 20 years. They'll make some money. They could have made more, but you don't want to be them. You want to be most optimized you can be. Same as you meet people who are like, I've been investing in stocks for 50 years and I got $10 million. And you're like, great, awesome. You could have 100 million if you had invested better, but they'll say, hey, I've made this money. Look how great I am. And it's like, well, let's look at the returns every year. Let's look at the cap rate on these properties. Let's analyze each of these deals and make sure that they make sense to keep in the portfolio. Portfolio optimization is super important in real estate, and a lot of people don't do it. In the small side of real estate, people don't do it. All right, how much was it to set up the LPGP structure? So an LPGP structure is like, I don't know, $4 or $5 grand. It's not a lot of money. You're gonna get some attorneys to set it up. You might have an accountant to review the structure and how they set it up. That's about it. Do you recommend multiple passports and citizenship? I do. I think that it's smart to have a passport on a slightly different continent. I think that the East and the West could go to war, and a safe place would be like Costa Rica or something to have a second passport. I like the Canadian passport. It's one of the most versatile, socially accepted passports globally. So I'm really happy I have my Canadian passport. I would ideally never get rid of my Canadian passport. I wouldn't get a passport in the Bahamas. You get a tax residency card, a 10-year permanent resident card. You still keep your Canadian passport. You don't get a Bahamas passport. You're a resident there. You live there. You're a tax resident there. And then I'd probably get another passport as a backup in like Costa Rica in case things ever went crazy, like bombs are flying into Florida, Bahamas is going to be affected. I'd rather be down in like Costa Rica where they have an amazing medical system, top 20 in the world for healthcare. So for aging, it's just culturally a great place. So that's probably where I'll end up for my next passport. But yeah, I think Bahamas makes the most sense to live. And it's like an apocalyptic thing. It's nice to have another passport in case, what if like the government tomorrow like just decides some random arbitrary like wealth tax or something. You want to have a place you can go. It'll become, if that happens and they come up with some random, like, hey, we can't balance the budget, so we're going to take like 20% of all the richest assets. Like we're just going to take their houses. That could happen. Like that, they would have the votes too, because 51% of people don't have a lot of houses. So they would vote and take for the majority. That could actually happen. That's a very likely scenario. And in that scenario, you're going to be able to piece out. You think the lineups are going to be like, the lineups are going to be to get a passport and say like the Bahamas or Costa Rica when Canada or United States comes out with some rule like that? If they came out, and I hope they don't, I don't think they will, but if they did, having that other passport is going to be really hard to get. So you want to already have it so you can just pick up and go. Like, all right, I'm out. Here's my exit return. Bye. You can't take my assets. Good, no problem. Right? But if you have nowhere else to go and your only passport is at one country, you don't have any options. And so I think options are important. If you have wealth, you should have options. Super important to have options. So, yeah. Hey, super chat. William says, evening, Mike, vinyl plank or tile in a basement unit. What do you prefer? William, for me, I think it depends on a couple of situations. So the first one is like, what is the ceiling height like? Do you have good headroom in there? Because tile, you're going to need to get the floor perfectly level, which could add some concrete. You're going to have to set up a mortar, then you have to put the tile on top of it. So you're talking about potentially more headroom loss because you're building your floor up. So if you got a bulkhead that's like 6'5.5" and you put in, an inch of tile with all the mortar and everything down, then your tile might be pretty thick. I've seen that happen where you lose like half an inch to an inch. That could be the difference between you passing code or not. So for that reason, I would say vinyl plank's better. They're both water resistant. Tile holds up better than vinyl plank. The seams in vinyl, they break and stuff. I wish I could show you guys a picture. There's a couple in the vinyl plank we installed here where like the seams just don't go together nicely. And over time they got dirt in it and debris and can move back and forth. It's a floating floor. Just doesn't hold up as well. At the same time, you get a really bad tenant who drops something heavy on a tile that can shatter a tile. The nice thing is you can just chip that tile up, and if you keep some extras in your furnace room, just put a new tile down. Whereas the vinyl click is all clicked together. It's a pain in the ass to fix it. So from a long-term maintenance perspective, if I had the headroom, I would go tile. It's indestructible with water, everything. So is vinyl, technically, but I would go tile. If you don't have the headroom and you're worried about headroom space, then I would go vinyl plank because you can lay it with a small underlay attached to the vinyl and you can get like, instead of this much space for tile, you can get like this much space taken for vinyl. And vinyl is quicker to install. It's cheaper to install as well. It's also water resistant and waterproof because it's made of PVC plastic. So yeah, hope that helps. Little things like that, right? Like most people don't know that stuff. And all of those little considerations come into mind when you're designing a space. And that's what I love. Like design is my thing. I hate construction. I'm good at GCing. I'm good at grinding trades down. I've been doing that for over a decade now. So I'm pretty good at finding affordable guys, and I'm pretty good at keeping sourced several sub trades to keep the projects moving. I burn through a lot of sub trades because I'm always picking from the bottom of the barrel. Like I'm finding flooring guys who will work for $1.40 a square foot or $1.10 a square foot labor cost. Now, if I paid $3 a square foot, I'd find guys that were super quality, always showed up, did a great job, but that's $3 a square foot. That's almost 300% more than what I'm paying. At the bottom of the barrel, you do find gems who are decent for a while, maybe unreliable after that. But because I try to focus on cost control so much, as the GC, like it's shitty GCing low quality budget projects because you get low quality budget people. And those people come with more drama, drinking, drugs, unreliability, whatever, quality deficiency issues. So you're dealing with more of that in the bottom of that space. So obviously, like if you're in construction, you're running a business, pro tips for people trying to run a business. And if you're a flipper, you're basically in construction business. So like they're tangent, or at least adjacent, some of the shared Venn diagram. But anyway, so construction can be very much a grind, and it can be very much one that ideally, like all the really good people in construction tend to all either get huge scale or they go into luxury. And all the good contractors I see go into luxury. And that's because you do a luxury washroom, it's the same, almost the same tile. Like the labor is the same. You got to install the tub, install the toilet, install the vanity, put a subfloor in, put the tile down, tile the backsplashes, minor touch-ups, whatever, paint. You do the exact same thing on a $2,500 washroom renovation or a $25,000 washroom renovation. And the difference is like a little bit nicer tile, a little bit nicer toilet, a little bit nicer tub. You might cut in the paint a little nicer, a little cleaner, but you can make 10x the returns. The margins are way fatter on luxury projects where you really gotta take your time. So that's, if you're good at the trades, you should do that. Is the luxury stuff, not the cheap stuff. I'd like to get into more of the luxury stuff because it's just a bitch working with the bread and butter guys, but the bread and butter is safer. Like in luxury real estate, you can get crushed, right? It can happen in a recession. There's more risk there, right? In the bread and butter stuff, I'm doing the cash flow stuff. That's just like your B and your C class type properties. It's hard to lose money in those spaces. The cash flow is strong. The costs are low. The ROI is there. So, all right, let's do some more Q&A real quick and I'll wrap this bad boy up. All the questions have pulled in now. Heard it's a good idea to buy property in Ukraine as property go up after the value after war. No, that's called speculating. So whenever you buy property, you know, in hopes of future appreciation, that's your only play, especially in a place like Ukraine. Like, it's a real possibility that nukes get dropped on like parts of Ukraine. Like, there could be a full-blown war, a proxy war, where the U.S. gets in there against Russia. Like, that's a real possibility. And China backs Russia. That could happen. I wouldn't touch Ukraine, and that's just because like I don't know anything about the market, so I can't comment. But it's far away. There's no allure for me to invest in. No, like in a war, any type of political instability to me is just run. Like, if I had properties in a country that goes to war, I'm selling everything. I'm out. Because buildings get destroyed in war, and insurance is like nearly impossible in times of war. So, no. I think there'll be a continuous conflict in that region for some time. I would definitely not buy property there. But you do you. You know, I'm sure there's someone out there who's going to exploit that and make some money. Hong Kong Fui says, Mike, what do you think or look at for when you're looking at homes on MLS? How you determine if they're a good deal? Is it about adding units? It depends. So it depends on the angle. There's always a play with every type of property and every type of area. There's multiple plays. Sometimes it's development. Sometimes it's adding a bedroom or bathroom. Sometimes it's just a cosmetic cleanup. Sometimes it's adding units. Sometimes it's like adding an accessory dwelling unit in the back of the property because the land calls for it. There's so many different angles and plays to make money, but it's always about finding comparable properties that are the end state of where you want to take the property to, and then finding properties that could become that. So if I find, like, I notice like, hey, there's a lot of properties selling for like 500 grand, and there's that are like cheap, and they don't have a garage. And I look in this price point, and all the same kind of property, same square footage, same characteristics, but doesn't have a 2-car garage, is selling for like 700 grand. And I know I can build a garage for 50 grand, a 2-car garage. I'm like, geez, there's an arbitrage opportunity here. And I look for that. As an example, it's just a random example. I wouldn't even, the garage thing is probably not even a play, but like, you know what I mean? Like, hey, duplexes in this area are selling for 200 grand more. I know I can put a basement apartment in for 90. So I know that there's $110,000 in margin. I look for projects that fit that criteria. I gotta go. My kids are losing their mind. I think it's bedtime for my youngest daughter. I gotta wrap this up real quick here. Hey, from Alberta. Hey, Yuri. Mike says, if you had to start all over and get a job, what do you recommend? I don't know, Mike. Like, for me, I would say any sort of like stable salary that you can use to get financing is probably desirable, but do something you enjoy, right? Like, you gotta love what you do, at least a little. I couldn't find any jobs that I really loved. I tried the accounting thing. I tried consulting. I ended up going consulting because it was more flexible, career-wise. But yeah. I would say, you know, wholesaling is a business, so you start the business, but starting an entrepreneurship without a solid base is very risky. It can be done. Some people excel at it right away, some don't. I think it just depends on the individual. So, yeah, I mean, being in the real estate industry would give you an edge, Mike, if you wanted to be in real estate for the long term. So I think there's for sure some synergies there. For sure, like insurance or real estate, you know, as an appraiser or a realtor, would give you some sort of edge for sure. Yeah, you could do those professions. Being an appraiser right now is tricky because there's not a lot of appraisals being conducted. No one's refinancing right now. Sales are really slow. So it could be a good time to get in because you're ready for the next bull market. You got experience and connections and networking already established in the bear market, and you could flourish in the boom market. But I think it's about, the job to me is just a means to an end. It's, to me, how you get your seed capital to start doing deals. So, and financing. But that was because I didn't know there was B-lender financing. I didn't even know there was commercial financing. I didn't know any of that stuff. Now that I know that you can take deals down without, you know, the need for a job. So it depends, I guess. Depends on the person. The least risky approach is to work the full-time job and to do the real estate. What are the steps to making an offer on a home without a realtor? Harriet, you cannot do it without a realtor on the MLS. So, well, no, that's not true. There are now a bunch of firms you can go through to do that. Like, you can, there's a whole bunch of, I'm trying to remember the names of all these things. Like Purple Bricks used to do it. Calm Free got bought out by Purple Bricks. but they used to have a program where they would give you 1% cash back. I think Zillow gives you a cash back. A lot of them give you cash back. You have to basically work through one of their agents to submit the offer. If it's MLS listed, there's a listing agent. The listing agent in some states and provinces can double list, or sorry, double end. Double ending is when that listing agent writes the offer with you and submits it to the seller. They're then working for you and for the seller. It's a conflict of interest. It shouldn't happen. It's a great way to get a good deal as a buyer because you have direct tap to the seller. Ideally, you'd have a buyer, like in a proper transaction to protect the consumer for a newbie. Not ideal for me, but ideal for the consumer. As the buyer of real estate looking for good deals, I don't want this. But to protect the consumer, you'd have a buyer's agent and a seller's agent. Each one would get 2%, 2.5% commission type thing. So that's typically how you do it, to find a real estate agent who will do that. Some agents will cash you back too if you don't do a lot of volume with them. You're just doing a few offers on really serious properties. Then they might give you some of their commission back. Like if they're collecting a 2.5% commission, they might give you 1% of that as a cash back towards your closing costs. I know I've done that for clients before, and it's a common thing. So yeah, that's how you go about doing it. If you're buying a property off market, so off Facebook, Kijiji, someone, neighbor you meet, someone at a real estate marketing event, you see a for sale by owner sign, then you just go print off like a form, type in like a Form 100. It's like a 6-page agreement to purchase and sale, fill it out and bring it to the seller, and you guys ink it up. That was how I did all my deals before I had a realtor when I was doing it off market. But I also had several realtors bringing me deals. So I did stuff on market and off market. When I was off market, there was no real estate agents involved. I would do my own offer. When I became an agent, so not like I'm a realtor now, now I do my own offers on MLS and off MLS. But yeah, you'd have to find a deal off MLS to write your own offer. Hope that helps. That was long-winded. Long in the tooth. All right, next question. Do you think now is a good time to buy real estate? I'm continuing to buy right now. So I'm bullish that the Fed will pivot early. And I think there's going to be good opportunities right now to continue to buy assets, quality assets, the cash flow. But I'm dollar cost averaging. So I'm not putting it all in now and stopping. I'm going to continue to buy this entire dip because I don't know when the bottom is. The bottom could be end of this year. The Fed pivots. Everything bounces back. It could be, 2-3 years from now. I will continue to buy throughout the whole recession. I'm going to keep going, right? So I don't know where the bottom is, but I'm going to keep buying all the way through. Harriet says, thoughts on the new first home buyer savings account coming this April? I think it's great. They're offering basically a TFSA for people saving. Shazam says there are more deal in Daytona Beach, owner finance deal condo. I don't understand what you're trying to say, but there are tons of deals in Daytona. Like, I don't much care for condos because condo fees suck and you have no control. So I look for detached properties, but with no condo fees and no HOA if I can, because then I have full control over what I can do with my asset. But in general, yeah, there's thousands of deals up and down the coast. Literally 1,000 deals for sale right now. Probably 100 of them are like bangers. Jason says, soon to be a grad, should I spend a few years building up my bankroll during my full-time before moving into real estate? Yes, Jason. I think it's smart to keep the full-time job and to do this on evenings and weekends. Because you can start your first property right away and start doing that grind while you're working a full-time job, no problem. Probably even do 3, 4, 5 properties. I was managing 17 properties while working full-time. It was hell, but I was able to do it. Why would anyone sell in the winter? Good question, Chuck. People sell for all kinds of reasons. Most people don't buy in that time either. They don't sell or buy. Jacob says, can you still find high cash flow deals in London? Nothing on the MLS makes sense. Is off-market really the only way? Yes, you certainly can. Certainly can, for sure. Thoughts on industrial real estate? I don't like industrial real estate for me. Any way to replace tiles? Yes, you can just chip out a tile if it's cracked. No problem. Yep. You definitely could chip out tile. You can chip out one tile at a time and replace it. A good tile guy can definitely replace a few tiles if you can find a match. Kids screaming in the background is hilarious. Yeah, I mean, I have like 3 kids, right? And even though the door is closed, they're like, one of them right now is like under the crack of the door trying to get in, unfortunately, so. Average returns, ROI on real estate, it depends. For me as an equity holder, I target like 20 to 25% every year compounded. So your cap rates are like 5 to 8. So without a, yes, baby, you can't come in right now. Daddy's doing a show. Go see mama. Okay, so if you're doing debt, it depends how you invest in real estate. So if you're doing first secured debt and you're getting like I offer this to investors sometimes where they're funding my stuff in first secured position, then there'd be a situation where like I would offer like a 10% fixed return, and I pay it monthly. So that's like very powerful. That is no risk because you're secured against the property. I'm in the equity position, they're in the debt position. So I have to lose all of my equity, all of the created equity, everything before they lose a dollar. Market pulls back huge in a big way. It's very hard to lose money in the first secure position. It's where the bank likes to be. So that's like your 10% risk-free, I would call it. If you want to take more risk and be in like a JV where you're buying the property and you're putting up the equity in the deal, you're not in the debt position, you're in the equity position. You not want a piece of the profit. Your return is potentially infinite if you can pull the money out, but it also could be negative, right? That's the risk of equity investing. It's often not. Like I've been targeting, I think in the last 10 years, my performance has almost always been 50 to 80% every single year on almost all the deals that I've done. Minus last year, I had a couple deals that didn't go as well because we bought towards, not the top of the market, but as it was falling. I think the market had fallen 15%, I started buying the dip. And some of those properties, I won't have as good of an ROI. But over a 5-year period, that property will come back, right? And I'll have cash flowed it the whole time. So I don't care about the appreciation, or I don't care what the current value is. If my plan's to hold that property for 10 years, I don't care what it does between now and then. I care what it's gonna be then. And I know in 10 years, it'll be way up. So I don't care what it does in the next 3 years because I wasn't gonna sell it either way. And so if it's cash flow positive, I'll just hold that asset and I'll win over the long term. And I aim from a cash flow perspective for between 10 and 25% ROI, as well as the appreciation lift on top of that. So that often juices it over long term with leverage to like a triple digit return. So that's what I target. To get to billionaire status, I'm gonna need like a 15% compounded annual growth rate to get there from where I am right now in a reasonable age, like by the time I'm like in my 60s, like early 60s. So yeah, that's what I'm going for as billionaire. We'll see how it goes. I mean, if I fall short and end up with 100 million bucks, it's like I just failed as an investor. I probably got like an 8 or 10% return. All right, I gotta go. I gotta wrap up the stream here. Thanks so much, everyone, for tuning in. I really appreciate it. Appreciate that you do this, Mike. Brings huge value to this humanity. Hey, no problem. Happy to help. Yes, Jason, I'm still planning on doing something. Veska says, I know you said you like Enbridge, but are there other stocks? Yeah, there's a ton of them. I shared on my Instagram stories. Go into my saved stories for stocks. You can see a bunch of the stocks that I like on Instagram at Mike Rosehart for dividend plays. Which bank for private banking do you recommend? It depends. I'm private banking with Bank of Montreal and with Scotiabank. So that's for me. I have friends who have good things at other places too. But anyway, thanks everyone for watching. The secret to unlocking wealth through you, 3 steps and control your financial future. Spend less, earn more, maximize returns in the difference. Bye everyone. And if you want to invest with me in deals in Florida, hit me up. You need to have like 500,000 or $1 million to talk, but hit me up if you're interested in that. Bye everyone. See you next week.